What is happening right now is not a headline problem. It is a system problem. Most people think they are watching a few ugly charts, a weak dollar, a few banks making gloomy forecasts, and another noisy year in the market. That is not what I see. I see the early stages of a world in which the United States is no longer the only financial gravity center on Earth. I see the dollar losing altitude, not in one dramatic collapse, but in the far more dangerous way these things usually happen. Slowly enough that most people stay overexposed until the damage is already done. That is why this matters. If you understand what is changing, you do not have to panic. You do not have to make heroic predictions. You simply have to stop pretending that the next decade will look like the last one. For most of the post-war era, the United States sat in the best seat at the table. After World War II, the dollar became the world's reserve currency. That one fact changed everything. It meant countries needed dollars to settle debts. It meant countries needed dollars to buy oil. It meant countries needed dollars to trade, and because the world needed dollars, the United States gained an extraordinary privilege. It could borrow more cheaply than other nations. It could run larger deficits than other nations. It could print more than other nations. It could be sloppier than other nations because the rest of the world kept absorbing the currency and financing the system. That arrangement made America stronger than most Americans even realized. It also made American investors lazy. When you sit at the center of the global order for long enough, you start to assume the center belongs to you forever. It does not. No arrangement in finance lasts forever. Every dominant system works right up until the moment the incentives start changing. And that is what is happening. Now, the phrase people like to use is changing world order. It sounds dramatic, it gets abused, but beneath the exaggeration there is something very real. Major shifts in the financial order have always created two things at the same time. They create huge wealth destruction for the people positioned for the old regime, and they create enormous opportunity for the people who recognize the new one early right now. By any reasonable reading of the trends, we are in the middle of one of those shifts. You can see it in the relative weight of the global economy. The Western alliance that built the present order no longer commands the same share of global output it once did. A coalition of countries that barely mattered together a few decades ago now represents a larger share of global GDP on a purchasing power basis than the Western bloc that defined the post-war system. That fact alone should make you pay attention, but it gets more important when you connect it to the dollar for years. Central banks around the world treated dollars as the safest reserve asset. They held them because the dollar was liquid, accepted everywhere, and backed by a system no one serious believed could be replaced. But that belief has weakened, not vanished, weakened. And in finance, belief is the whole game. A decade ago, the dollar accounted for roughly 2/3 of global foreign exchange reserves by 2024 and 2025. That share had already fallen meaningfully. That is not the same as collapse. It is something more subtle. It is market share loss. And market share loss in a reserve currency matters because reserve currency status is not protected by nostalgia. It is protected by usage. The more the world needs your currency, the stronger the system remains. The less the world needs it, the more your privilege gets diluted. That is exactly why people started talking about dedollarization. Now, I do not like grand slogans. Most of them hide weak thinking. But the mechanism underneath this one is simple enough. Countries looked at what happened when Russia's reserves were frozen after the invasion of Ukraine, and many of them drew the same conclusion. If reserves can be weaponized, then depending too heavily on the dollar comes with political risk as well as financial risk. So they started doing what rational actors always do when the cost of dependence rises. They diversified, some diversified into gold, some diversified into each other. As currencies, some began building payment rails that reduced their need to route everything through the dollar system. None of this replaces the dollar overnight. That is the wrong way to think about it. You do not need to destroy the incumbent in one move. You simply need to make the incumbent less necessary at the margin. If enough marginal flows move elsewhere for long enough, the system changes. China gives you a clean example of this. For years, China held a massive share of its reserves in U.S. treasuries. That was a direct expression of confidence in the old structure. But by 2025, that exposure had been cut sharply compared with prior years. At the same time, China has built its own cross-border payment infrastructure to facilitate transactions in yuan. Again, that is not a final replacement, it is an alternative lane. And alternatives are what matter in the early phase of structural change. The same pattern shows up elsewhere. countries settle bilateral trade in local currencies. Central banks buy gold at aggressive rates because gold does not depend on another country. S-permission new payment platforms are designed so trade can happen without relying on Western-controlled messaging systems. Digital settlement ideas tied to baskets of currencies and hard assets keep getting tested because the incentive is clear. If you can reduce reliance on the dollar without giving up too much efficiency, you eventually will. That is the real story. Not that the dollar disappears, not that China wakes up one morning and takes over the world, not that one meeting flips the board. The real story is that the dollar is being used a little less, trusted a little less automatically, and challenged a little more deliberately. And when a reserve currency loses automatic demand, the consequences show up slowly at first and then all at once in returns. That brings us to the question that actually matters to you. What does this mean for your money? It means the next decade is unlikely to reward blind concentration the way the last two did. For a long time, the easiest profitable habit in the world was to be overwhelmingly invested in America and let the system do the heavy lifting. That was not stupidity. It was a perfectly rational response to the strongest market, the strongest companies, the deepest capital pool, and the currency at the center of trade. But once the world starts broadening, once growth starts diffusing, once the dollar starts weakening at the edges instead of strengthening automatically, that same concentration starts to look more like an assumption than a strategy. The major institutions are already telling you this in their own language. Vanguard has projected lower annual returns for U.S. stocks over the next decade than many investors have become used to. International markets on their numbers look somewhat better. J.P. Morgan has been more constructive on emerging markets. Fidelity has also projected stronger long-run outcomes outside the United States than most Americans instinctively expect. When several large institutions working from different models arrive at a similar conclusion, I pay attention. Not because they are always right, because consensus shifts at the institutional level usually tell you the old baseline is no longer secure. And the old baseline here was simple. The United States would continue to dominate returns the way it did before, and everyone else would remain a sideshow. That assumption is being repriced. There are several reasons for it. One is valuation. American equities have been expensive relative to much of the rest of the world. When the baseline price you pay is already high, future returns tend to be lower unless earnings outrun even optimistic expectations. Another is concentration. A small group of giant companies makes up an enormous portion of major U.S. indexes. That concentration can be wonderful when the leaders keep leading. It becomes a risk when leadership narrows, growth disappoints, or capital rotates. A third reason is currency. If the dollar weakens over time, foreign assets that merely perform adequately in local terms can become more attractive to us investors once those returns are translated back into dollars. And the last reason is growth composition. The next era may simply belong to more than one region. That is where China gets most of the attention, but the broader diversification story may matter even more. India is young, large, increasingly digitized, and still early enough in its development curve that the room to grow remains substantial. Emerging markets as a group are expected to represent a much larger share of the global equity market over time than they do today. That does not mean every emerging market is a gift. It means the world's future growth may be less American by default than its recent past was. That distinction matters. A lot of investors hear a thesis like this and immediately make the wrong leap. They assume the conclusion is to abandon the United States. That is not my conclusion at all. The United States still has enormous advantages. It still has the deepest, most liquid capital markets in the world. It still has an innovation engine few countries can match. It still dominates in crucial industries like artificial intelligence, semiconductors, and biotechnology. Its military reach and financial infrastructure still matter enormously in moments of crisis. And that is why, even now when panic hits, capital still runs toward America far more often than away from it. That is also why I do not believe in a dramatic dollar death script. There is no clean successor waiting in the wings. Europe has fragmentation and debt problems. China has capital controls, which is a serious obstacle for any currency that wants reserve status. Gold cannot settle modern global commerce in real time. Bitcoin remains too volatile to serve as the dependable base layer of a reserve system. So no, I do not see a clean handoff from the dollar to some new sovereign king. What I see is a dilution, the United States moving from being the only global superpower to being one superpower among other major poles. That process can take decades, but when it begins, the investors who benefit are usually the ones who reposition before the headlines become conventional wisdom. So what do I do with that? I start with a very simple principle. I do not bet my future on one country staying on top forever. That sounds obvious, but most portfolios do exactly that. If the United States keeps dominating, a diversified investor still does fine because America remains a major part of the world economy and a major part of the portfolio. But if America's dominance softens and growth broadens, the investor who never diversified has accepted a risk they were not paid enough to take. So the first move is straightforward. Do not go all in on the United States. That is not a call for panic. It is a call for proportion. A strong American core still makes sense. But an all-American worldview in a broadening world is no longer prudence. It is habit. The second move is equally simple. Own international and emerging market exposure in a way that is cheap, diversified, and boring. Most people do not need a dozen clever regional bets. They need a rational slice of the world outside their home country. If international markets merely narrow the valuation gap, that helps. If emerging markets become a larger driver of world growth, that helps. If the dollar softens, that helps. You do not need heroics for that thesis to work. The third move is one I resisted for years longer than many people did. Take precious metals seriously, but keep them in their proper place. I am not talking about building your life around apocalypse. I am talking about respecting what central banks themselves have been doing. When official institutions buy gold at the strongest pace in decades, they are telling you something very plain. They want an asset that cannot be printed and cannot be frozen by another sovereignist domestic politics. That does not make gold a growth engine. It makes it a hedge against confidence erosion, and in a world where debt keeps rising and currencies keep getting diluted, a modest hedge is not irrational. The fourth move is to own what the world needs regardless of who wins the political argument. That means commodities and real assets, in a measured way energy metals. Copper, the raw material base of industrial civilization, as more countries build, electrify, defend, and consume, those inputs remain relevant. If supply shocks increase or inflation stays sticky, these assets can help absorb some of the damage. The fifth move is the one people are most likely to misunderstand. Do not abandon the United States. Even with lower expected returns than before, America remains too innovative, too liquid, and too central to dismiss. A 4 to 6% world from U.S. equities is still a world in which disciplined investors can do very well. The mistake is not owning America. The mistake is expecting the last 20 years to repeat, simply because they were convenient. That is the heart of this whole discussion. We are not talking about catastrophe. We are talking about adjustment. We are talking about a world in which the dollar still matters enormously, but a little less than before. A world in which the United States still leads in many categories, but not as unchallenged as before. A world in which global growth is likely to come from more than one place. A world in which diversification is no longer an academic exercise. It is a practical response to a multipolar future. I have seen enough cycles to know that most people miss structural change for one reason. They keep waiting for it to become obvious. By the time it is obvious, the easy money is gone. So I would not treat this as a moment to sell everything. I would treat it as a moment to remove lazy assumptions. I would not chase every new story about the end of the dollar. I would simply accept that the world is getting bigger, growth is getting broader, and America may remain exceptional without remaining singular. That one shift in thinking can change an entire portfolio. If the United States continues to dominate, fine, you still win because you still own it. If leadership broadens, you are no longer trapped in a one-country bet pretending to be diversified. And if the dollar weakens gradually over time instead of collapsing theatrically, you are positioned for the world that actually tends to arrive. The one that changes slowly enough for complacent people to ignore it and fast enough for disciplined people to profit from it. That is how I would think about this, not as a crisis, as a reweighting, not as the end of America, as the end of assuming America is the only story that matters. And for a patient investor, that may be one of the biggest opportunities of the next decade.